Hello and welcome back to the Financial Freedom Show. As I'm recording this episode, there's currently a big drop in the stock market today. The S&P is currently down 2.65% and the Nasdaq is down over 4% today. So there's quite a big drop and a lot of investors are panicking. There's a lot of content here on YouTube of people panicking and talking about how there's going to be a recession and all this stuff. So I thought it would be interesting to make a video about the current situation and what I think and what I'm going to be doing with my portfolio. So if you enjoyed today's video, be sure to hit the like button and subscribe in order to stay up to date with the latest videos we post on the channel. And feel free to comment down below what you're doing in your portfolio. Are you holding on to your stocks? If you'd like to have your name featured at the end of every single video we publish, be sure to check out our membership link in the description. You can also have early access to every single video we publish as well. And without further ado, let's get into the video. So investing in the stock market can be unpredictable with fluctuations that can lead to significant gains or losses. One of the most effective strategies for navigating market volatility is dollar cost averaging, or DCA. This investment approach involves consistently purchasing a fixed amount of assets at regular intervals, regardless of the market conditions. The recent drop today in the stock market underscores the importance of this strategy, demonstrating how it helps investors mitigate risk, take advantage of lower prices, and maintain a disciplined long-term approach to building wealth. One of the main benefits of dollar cost averaging is that it reduces the emotional stress associated with market fluctuations. When investors attempt to time the market, they often buy when prices are high due to optimism and sell when prices are low due to fear, resulting in poor returns. DCA eliminates this issue by ensuring that investments are made systematically, removing the guesswork from investing. The recent market drop provides a perfect example of why this strategy is so valuable. Many investors who tried to time the market may have panicked and sold their investments at a loss, only to see stock prices recover later. There was a rally in 2023 that was called the most hated rally of all time. Basically, it happened right after the market crashed, and it was unexpected. People thought the market was going to continue to go down, so it's almost impossible to time these events. However, those who consistently invested at regular intervals, bought their shares at a lower price, and effectively lowered their overall cost basis, positioning themselves for future higher returns when the market rebounded. One of the biggest advantages of dollar cost averaging is that it allows investors to buy more shares when prices are lower, and fewer shares when prices are higher. This means that over time, the average cost per share is lower than the average price per share. For example, if an investor commits to investing $500 per month into an ETF or stock, they'll acquire more shares when the market declines and fewer shares when the market prices are high. The recent downturn in the market highlights the power of this approach. Instead of fearing the drop, disciplined DCA investors viewed it as an opportunity to accumulate assets at a discount, ultimately leading to greater potential returns when the market recovers. A key reason why dollar cost averaging is so effective is that it enforces investment discipline. Many investors struggle with staying invested during periods of market downturns, often making emotional decisions that hurt their long-term financial goals. DCA, or dollar cost averaging, removes the need to make frequent trading decisions and keeps investors focused on the bigger picture, consistent, steady investing over time. Market downturns, such as the recent one, often create fear and uncertainty, causing many investors to abandon their plans. However, those who stick to a DCA strategy maintain their investing habit regardless of market conditions, ensuring they continue to build wealth even during turbulent times. The recent market decline serves as a strong reminder of why dollar cost averaging is such a powerful strategy for investors. By consistently investing over time, DCA reduces the impact of volatility, allows investors to accumulate more shares at lower prices, and reinforces long-term financial discipline. Instead of trying to predict market movements, Investors who employ DCA stay the course, benefiting from both downturns and recoveries. For those who are looking to build wealth steadily and avoid emotional investing pitfalls, dollar cost averaging remains one of the most effective strategies available. While dollar cost averaging is an effective strategy for long-term investing, the choice of what to invest in is just as crucial. Many investors are drawn to individual stocks in the hope of finding the next big winner, but the risks of stock picking can be significant. Exchange-traded funds, or ETFs, offer a more reliable and diversified approach to wealth building, making them an ideal choice for long-term investors. This recent market drop further highlights why ETFs provide a safer and more strategic investment option compared to individual stocks. One of the biggest advantages of investing in ETFs is diversification. When an investor buys an individual stock, they're putting their money into a single company, meaning that their returns depend entirely on that company's performance. If the company struggles or collapses, the investor could face significant losses. In contrast, an ETF holds a basket of stocks, spreading risk across multiple companies, sectors, or even entire markets. For example, an ETF like SCHD, or the Schwab US Dividend Equity ETF, or VTI, the Vanguard Total Stock Market ETF, give investors exposure to a wide range of companies. Even if a few underperform, others may rise, helping to stabilize overall returns. During the recent market downturn, many individual stocks suffered deep losses, but well-diversified ETFs experienced less extreme declines or even gains with SCHD, demonstrating their resilience. Investing in ETFs ensures exposure to high-quality companies without the need for constant research or stock picking. Well-structured ETFs such as SCHD, VOO, or DGRO automatically include top-performing companies in their portfolios. These ETFs adjust their holdings over time, meaning that investors don't have to actively manage or guess which stocks will perform the best in the future. During market downturns, strong companies tend to recover faster than the weaker ones. ETFs that track major indices or indexes and specific themes ensure that investors benefit from the long-term growth of the market, rather than suffering major losses from betting on a single failing company. The recent drop in the market is a reminder that even strong companies can decline temporarily, but ETFs protect investors by balancing risk across multiple holdings. Many investors try to pick individual stocks, hoping to invest in the next Apple or Tesla. However, for every successful company, there are many that underperform or even go bankrupt. The risk of picking the wrong stock is high, especially for those who lack the time or expertise to analyze companies in depth. For example, investors who bought once promising stocks like Peloton or Zoom at their peaks saw significant declines in value, while diversified ETFs continued to grow over time. This recent market drop further illustrates this risk. Some individual stocks may never recover, while ETFs composed of strong, diversified assets will likely rebound as the market does. ETFs also provide lower costs and greater tax efficiency compared to actively buying and selling individual stocks. Most ETFs have low expense ratios, meaning investors pay minimal fees to own a broad portfolio of stocks. Additionally, ETFs tend to be more tax efficient as they are structured to minimize capital gains taxes compared to actively managed mutual funds or frequently traded stocks. By consistently investing in ETFs through dollar cost averaging, investors benefit from reduced risk, steady compounding returns, and lower overall costs. While investing in individual stocks can be tempting, the risks are significantly higher compared to ETFs. The recent stock market drop reinforces the importance of diversification, risk management, and long-term stability, advantages that ETFs provide naturally. By focusing on broad market ETFs or sector-based funds, investors can achieve long-term growth without the stress and risk of stock picking. When combined with dollar cost averaging, ETFs offer one of the most effective paths to building sustainable wealth over time. So what am I doing with this current stock market drop? I'm continuing to buy more shares in broad market ETFs. If you enjoyed this video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos we post on the channel. And feel free to comment down below what you're doing in your portfolio. Are you buying with this recent drop? And I'd love to hear from you in the comments. And if you'd like to have your name featured at the end of every single video we publish, as well as have access to every video we publish early, be sure to check out our membership link in the description. Thanks for watching, and I'll see you in the next one.